The outcome of the next US presidential election could dramatically swing your real estate investments by up to 15% by this new year. Imagine being on the brink of a decision that could either skyrocket your portfolio or plunge it into uncertainty. Now, that's the critical juncture we find ourselves at right now. And it's precisely what we are unpacking today at ECMP Studios. In this video, we are going to cover candidates' economic agendas, strategies to navigate the market regardless of who wins. Is the Fed and White House in bed together? And a special giveaway at the end of this video. But first, I need for you to like, subscribe, and turn on the notification bell so that we can brace for this potential impact together. Welcome to a comprehensive breakdown of how the upcoming presidential election is scheduled to reshape your investment strategies in unexpected, immediate ways. Forget about gradual shifts. We're facing rapid, substantial changes that can take shape the moment the new president assumes office. The stakes are incredibly high, particularly when it comes to interest rates, the crucial lifeline of commercial real estate financing. A 1% fluctuation can significantly alter your financial standing overnight. Stay to the end of this video because we will share a strategy that the most aggressive investors use to shield their portfolios during these politically volatile times. This guide is called the ECMP Election Booster Strategy Guide. It will protect you like a booster shot during flu season, regardless of who wins any election. And that's not all. For those hungry for deeper insights, click here for our extensive playlist that covers all relevant issues to interest rate movement. With the upcoming US presidential elections, it's crucial for commercial real estate investors to understand the economic agendas of Kamala Harris and Donald Trump. Let's explore how their potential victories could reshape the landscape of commercial real estate through their distinct policies. Now, let's discuss if Kamala Harris wins. A Harris administration would likely prioritize sustainability, infrastructure development, and social equity, potentially funded by increased corporate taxes and higher taxes on the wealthy. The emphasis on green infrastructure and affordable housing could significantly influence commercial real estate markets. First, let's discuss the potential impacts. Number one, boost in infrastructure and green projects. Expect a surge in demand for industrial real estate and logistics spaces as government projects expand under increased infrastructure spending. Number two, increased operational costs from regulation. Stricter environmental regulations could drive up costs, but also open opportunities in sustainable developments and retrofitting existing properties to meet new standards. Now, next, let's talk about mitigation strategies. First, invest in sustainable developments. Adjust your portfolio to include properties that could benefit from federal sustainability initiatives, such as energy-efficient buildings and developments that utilize renewable energy sources. Number two, plan for higher taxes. Develop strategies to manage the potential financial impact of increased taxation, such as restructuring assets or leveraging tax incentives for green investments. Now let's discuss if Donald Trump wins. A Trump presidency might focus on economic stimulation through deregulation and tax cuts, potentially leading to short-term growth in the real estate sector. However, this approach could also introduce elements of economic uncertainty. Let's discuss the potential impacts for this one. Number one, stimulated developments from deregulation. Reduced regulatory barriers could lower costs and accelerate new commercial and residential projects, benefiting investors in the short term. But let's discuss economic uncertainty. Trump's unpredictable policy shifts, especially in trade and fiscal policy, could lead to economic volatility, affecting market stability and investment security. How about the mitigation strategies? Number one, capitalize on regulatory changes. Take advantage of deregulation to initiate or expand development projects quickly before any potential regulatory reversals. Number two, prepare for market fluctuations. Enhance liquidity and diversify investments to buffer against potential economic shocks. Fixed rate financing might be advantageous to guard against sudden interest rate increases. Now, let's talk sector specific strategic responses. For industrial sectors, both of the candidates could influence this sector differently. Harris, through infrastructure spending, boosting demand, and Trump, through deregulation, making new developments easier. Well, how about commercial sector? Prepare for shifts in consumer and business spending patterns influenced by each candidate's fiscal policy. As we navigate these possible changes, we will delve into strategies, including a special bonus giveaway, if you stick around till the end, to help you adapt your portfolio effectively. These strategies are designed to protect and potentially enhance your investments, regardless of the election outcome. As commercial real estate investors, understanding how to navigate the market post-election is crucial. Now, let's break down some of the predictive strategies that can help you adapt and thrive no matter the election outcome. We're focusing on action you can take immediately following the election results to safeguard your investments. Let's discuss market analysis and prediction tools. First up, leveraging data analytics. Guys, you have to utilize advanced market analytic tools like Reonomy and CoStar to predict trends and assess potential impacts based on historical data and election outcomes. Now, these tools can provide scenario analysis that helps predict how different commercial sectors might react to the fiscal policies of the winning candidate. By the way, today is your lucky day. ECMP has access to CoStar platform and can share valuable insight directly with you. Contact us to get started ASAP. Next up, let's talk economic indicators. You have to keep a close watch on key economic indicators such as GDP growth rates, employment data, consumer spending, and much more. Now, these indicators often signal how the broader economy might respond to a newer administration's policies. Now, let's discuss sector-specific forecasting. First of all, office real estate. Anticipate changes in demand for office spaces, particularly in relation to evolving work-from-home policies influenced by the new administration. For example, a push for more remote work could reduce demand for office space, whereas policies favoring corporate tax breaks might boost office market investments. Number two, let's discuss retail and industrial sectors. Retail might experience volatility based on consumer confidence and economic stability, whereas industrial sectors could see growth due to changes in trade policies or infrastructure spending. Adjust your investments focused based on these forecasts. Portfolio diversification. Diversify your portfolio to mitigate any type of risk associated with any single investment sector. Now, if a particular sector is heavily influenced by the election results, positively or negatively, having investments in other areas can balance your portfolio's performance. Next up, let's discuss strategic partnership and networking. First, you have to build relationships. Strengthen relationships with other industry professionals, lenders, brokers, and even investment partners who can offer diverse perspectives and resources during these uncertain times. Next, policy influence and advocacy. Engage with real estate professionals like my team who stay on top of market trends. Being part of our network can provide early insights into potential market changes. Next, let's discuss long-term planning and flexibility. First up, adaptive investment strategies. Guys, You have to develop a flexible investment strategy that allows for adjustments as the post-election economic landscape becomes clearer. Now, this may involve shifting from short-term speculative investments to focusing on long-term income-generating properties. Next, continuous learning and adaptation. You have to stay informed about market trends, political changes, and economic forecasts through continuous education. Regularly attending ECMP sponsored seminars, webinars, and conferences can keep you updated and prepared. Better yet, comment the word VIP below if you want to sign up for our VIP seminars dedicated to individual solutions sponsored by ECMP. Now, let's quickly recap. So far, we have talked about number 1, the existing economic policies. Number 2, who wins if Harris or Trump win. And number 3, strategies that you can use no matter the outcome. Up next, let's discuss securing fixed interest rates. Let's discuss securing fixed interest rates. Picture this. The election is over, and now you need to protect your investment against interest rate volatility. Now, how are we going to do it? First up, guys, you have to monitor active rates. Keep a daily watch on interest rate trends using financial news sources and specialized tools like Bloomberg and Reuters. Now, this will help you anticipate movements and plan your actions in advance. Number 2, engage with financial experts. Regular consultations with financial advisors or mortgage brokers can provide insights and timely advice on when to lock in rates or refinance. At ECMP, we know a wide variety of advisors that we trust and we can get you to get started. Now, let's discuss the benefits for locking in interest rates. First up, you have to establish cost predictability. Secure a fixed interest rate through refinancing or initiating new loans during low rate periods. Now, this approach not only offers budget stability, but also protects your cash flow down the road. Next, let's discuss contract negotiation techniques. Guys, when negotiating loan terms, regardless of the size of your portfolio, aim for the lowest possible fixed rate by comparing offers from multiple lenders. Leveraging the strength of your current investment portfolio to negotiate favorable terms. Smaller investors should focus on highlighting the stability and potential growth of their properties to enhance their negotiating position. For both large and small players, consider seeking advice from financial experts like us at ECMP to structure your negotiations effectively, ensuring you secure the best possible terms. Let's break down a couple of smart moves you can make to really draw interest to your properties and grow your portfolio. First, boost investment appeal. When you're showing your properties, highlight that they come with low fixed rate financing. This is a huge plus for investors who are looking for financial stability and predictable costs. It's all about making your property seem like the safest and most attractive bet for their money. 2, be proactive with acquisitions. With interest rates still low, now is a great time to think about snapping up more properties. Now, getting these deals done with low interest rates means you can expand your holdings affordably before rates start to climb. Now, think of it as getting ahead of the curve and setting yourself up for greater profits down the line. Before the elections force the Fed to interact one way or another, find a way to proactively work on this strategy. Now, let's focus on sector-specific plans. First up, for retail and hospitality. Now, properties in these sectors lock in low rates before any post-election economic policy changes that could lead to increased costs, thereby maintaining manageable operational expenses and appealing investment metrics. Now, for office spaces, utilize fixed rate financing to fund constructions or renovations, ensuring that these projects are financially viable even if the market conditions shift. By proactively locking in interest rates and utilizing strategic financing, you can safeguard your commercial real estate investments from the unpredictable waves of post-election economic changes. Now, implementing these actionable steps will not only secure your current assets, but also position you for growth as the market evolves. Now, that we have explored how securing fixed interest rates can provide long-term stability and positively influence the demand for your commercial properties, let's explore how to leverage refinancing and buying strategies effectively. Guys, as we prepare for the election outcomes, it's crucial to understand how the victory of either Donald Trump or Kamala Harris could reshape strategies in the real estate market. Let's navigate through potential refinancing opportunities and the strategic timing for acquiring new properties under each potential presidency. As mentioned before, under Trump's potential re-election might continue to encourage deregulation and tax incentives, which could spur economic growth and maintain or even reduce interest rates. Now, this environment would be opportune for refinancing existing properties to lower costs and for aggressively acquiring new properties in markets likely to benefit from these policies, such as commercial and industrial real estate. Now, under Harris, a win for Kamala Harris could bring tighter regulations and an increase in public spending on infrastructure, possibly leading to higher interest rates to curb potential inflation. In this scenario, securing fixed rate refinancing before rate hikes would be strategic to control costs. The focus on infrastructure might also open new opportunities for acquiring properties in areas slated for development projects, particularly in urban settings or green technology sectors. Now let's discuss tailoring acquisition strategies. Under Trump, with a focus on bolstering the economy, areas poised for commercial expansion would be prime targets for acquisition. Investors should consider markets that are likely to see growth from deregulation and lower taxes, positioning their portfolios to benefit from rapid economic expansion. However, under Harris, expect a push towards sustainable development and potentially increased funding for housing and urban development. Now, properties in areas that would benefit from government spending on public infrastructure, like mixed-use developments and green initiatives, might be particularly attractive. Now, this could be an excellent time to acquire properties that align with these initiatives, leveraging public sector spending to drive private investment returns. Now, let's discuss refinancing in different economic climates. With Trump, anticipate a potential continuation of lower interest rates. Refinancing during his administration might aim to leverage growth-oriented economic policies, locking in low rates for the long term on your most valuable properties. With Harris, prepare for the possibility of rising interest rates as a countermeasure to increased public spending and potential inflation. Now, investors might consider refinancing before her inauguration to secure lower rates, particularly for properties in sectors likely to be affected by her regulatory policies. However, regardless of who wins the election, understanding how to strategically time your refinancing and acquisitions can significantly enhance your investment outcomes. By aligning your real estate strategies with anticipated federal policies and economic shifts, you can navigate post-election changes effectively. Staying informed and ready to act swiftly on these strategies will be the key to maintaining a robust and profitable real estate portfolio in the face of political and economics fluctuation. Having explored how the election results could affect our real estate strategies, let's now move on to our final segment to reveal some essential tactics and a special bonus strategy to safeguard your investments. Guys, we have journeyed through the implications of the upcoming presidential election on real estate strategies. discussing both refinancing and acquisition. Now, let's wrap up with a robust strategy and introduce a giveaway that will bring everything we have discussed into perspective. Now, let's talk about implementing a proactive investment strategy. Adaptability. The key to thriving in a fluctuating market is adaptability. By staying informed and ready to pivot, you can leverage changes in interest rates and policy to your advantage. Next, risk management. Employing a diversified approach to your investments can help mitigate risks associated with political and economic shifts. This means spreading your investments across various types of real estate and geographic locations. I want a shout out to everybody who has stayed till the end. I did want to mention the special bonus we promised, the ECMP Election Booster Strategy Guide. This guide distills the strategies we have covered into actionable steps that you can apply to your own real estate portfolio. It includes tips on how to assess the impact of interest rate changes, policy shifts, and market dynamics. By applying the insights from this guide, you can anticipate potential market movements and adjust your investment strategies accordingly. This proactive approach helps safeguard your assets against volatility and ensures continued growth. To get your hands on the ECMP Election Booster Strategy Guide, review the instructions in the description below. This cheat sheet will allow you to compare the potential impacts we have discussed to your own portfolio, giving you a tailored understanding of how to navigate post-election changes. Now, as we anticipate the results of the election, remember that the most successful investors are those who plan for various outcomes and remain flexible in their strategies. By using the tools and strategies discussed today, you are better prepared to face whatever the market might bring in the coming years. Don't forget to like, subscribe, and turn on notifications for more insightful real estate investment strategies from ECMP Studios. Let's keep learning, keep planning, and as always, keep it real. Stay